When investing, it's important to understand the nature of compound interest. What if I told you that 99% of Warren Buffett's wealth was accumulated after the age of 50? Does that sound far-fetched? Well, let's take a look at the numbers. According to multiple sources, Buffett's wealth was about 300 million at the age of 50. At age 95, which is where we are now in 2026, it's $143 billion. So that's not 99%, that's 99.8%. So let that sink in for a second. 99.8% of Warren Buffett's wealth was accumulated after the age of 50. How is this possible? To understand, let's take a look at a simple compounding graph. In this graph, we took $1,000 and we gave it a rate of return of 20%, starting at the age of 20, ending at the age of 95. So we use a 20% rate of return because this roughly mimics Warren Buffett's return, because Buffett famously invested at just over 22% for decades, making him one of the best investors of all time. Now, other investors have had higher rates of return than Buffett, but not for such a long period of time. Now, as you can see, in the beginning years, it almost looks like it's not compounding, but I'll show you something really quickly. If we take a look at age 60, we see that $1,000 has compounded to about $1.7 million. And if we made this graph until age 60 instead of 95, we could see there's our $1.7 million right there. And the graph looks a lot different. So from age 20 to age 60, there's a lot of compounding happening. It just is small relative to when the compounding really gets going later on in life. And as you can see from this graph, going back to our original point, at age 50, we could see that the net worth at age 50 is a fraction of where it is at 95. Now, I know what you're thinking. You're thinking, great, Cam, that's Warren Buffett. I'm not going to be able to compound wealth at 20%. Also, I can't start compounding at age 20 because I'm not 20 anymore. And those are both excellent points. But before we address them, let's see what we can learn from Buffett. So I have two quotes that I want to share with you. One is directly from Warren Buffett, where he says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the second quote is from his partner, Charlie Munger, who said, the first rule of compounding, never interrupt it unnecessarily. So with those two quotes in mind, I have a bit of a mantra when it comes to investing, and it's based on Charlie Munger, Warren Buffett, Peter Lynch, and a lot of very successful investors. And it's simply this. Number one, invest in wonderful companies that, number two, are well positioned for the future. And number three, don't interrupt the compounding unnecessarily. In other words, hold for long periods of time. Okay, let's look at another example that your everyday investor may be able to achieve. Here we have another chart similar that has an initial investment of $1,000, a rate of return of 8%, again starting at 20, this time ending at age 65, and also a monthly contribution of $500, which is of course about $6,000 per year. Now let's say this average investor works hard and they invest their money, and at age 50, they're a little bit disheartened because their entire portfolio is worth about $810,000. Because they do some quick math and realize with their style of living, it might be hard to retire off around $800,000. However, if they stick to the process, that $800,000 by age 60 becomes $1.8 million, and by age 65 is $2.7 million. So early in the video, I talked about what if you're not 20 years old anymore? And also you can't compound wealth at, let's say, 20% like Warren Buffett. Here's the answer. Regardless of where you are, the best time to plant a tree is 20 years ago. The second best time is right now. So let's get started. We have to do the best we can with what we got. So again, one of the secrets of investing is never interrupt that compounding process. And it's near the end where you're going to see the biggest gains, or I guess not near the end, but near the end of your working life where you'll see the biggest gains in terms of your net worth. Another way of looking at this is at the halfway point in terms of time. You may be a fraction of the overall wealth that you will achieve, but halfway through on a time basis, your investing period. And this type of compounding is all around us. Think about the Ice Age. Scientists couldn't figure out what major event brought about the Ice Age. It turns out there wasn't any major event. It was just compounding. There was a small change in the Earth's orbit, which caused snow to stay on the ground a little bit longer. That caused light to reflect off that snow back into space. The next year, that caused a little bit more snow because it was cooler, which caused more reflection, which caused cooler temperatures, and on it went for thousands of years until planet Earth ended up going through the Ice Age. Here's another example. Let's say you decide you're going to work out. You run to the gym, you do a workout, run home, look in the mirror, and you see nothing. The next day, you get even more motivated. You run to the gym. You do an even harder workout. You run home, look in the mirror, and you see nothing. Because you see nothing, you think it's not working and you quit. Or if you believe it is the right course of action, you stick with it. You commit to the regime, and you will absolutely start getting into shape. It's not about the intensity, it's about the consistency. And it's the same with compounding wealth. All right, let's jump back into our spreadsheet and do one more example that's a little more aggressive, just to show you how small changes can have big differences if held consistently over long periods of time. In this example, we're going to invest $20,000 initially at a rate of return of 10%. The starting and ending ages of 20 and 65 are the same. And this time we're going to invest $1,000 a month, which is of course $12,000 a year. Now you can see with this example, at age 50, we already reached that $2.7 million mark. And believe it or not, by age 65, we're at $12 million. That is the power of compounding. And just by way of example, using the same parameters that we just talked about, $20,000, a 10% rate of return, and of course our monthly contribution of $1,000, our first $1 million will take 22 years to achieve. Our second million will take only 6 years. I say only 6 relative to the 22. Our third million, 4. Our fourth million, 3 years. And our fifth million, 2 years. And as you can see, the time to our next milestone, in this case $1 million, decreases at a decreasing rate, whereas compounding itself, how you grow your wealth, increases at an increasing rate. Now, in real life, will it be a nice smooth line like this graph? Of course not. Markets simply don't work that way. The price you pay for the outperformance of equities, of stocks, is volatility. I'll say that again. The price you pay for the outperformance of equities over other asset classes is that volatility. This graph is 45 years. Let's take a look at the last 45 years. As you can see, it's not a straight line. But through it all, if you can build a portfolio of wonderful companies that are well situated for the future and hold through good times and bad times, including wars, pandemics, interest rate shocks, political upheaval, etc., and never interrupt that compounding process, then you can achieve this type of portfolio. As always, an investment in knowledge pays the best dividends. I hope this helps, and we'll see you next time.